If I didn't have Greg Weldon coming up, I'd just keep playing that music, but the great Greg Weldon's with me in just a moment. But first off, it's time for the Money Talks Quote of the Week. This comes from Nassim Nicholas Taleb. You know him as the author of The Black Swan, or a very good book called Fooled by Randomness. And here it goes, in quotes. For the protesters that we see all around the world and self-described progressives everywhere, as a teenager, I was a utopian. I found adults and adulthood fundamentally corrupt, self-serving, and unclear. I still do, but now I find the utopians even more harmful. End of quote. Greg Weldon joins me now on the line, of course, the author of The Weldon Report, all sorts of stuff. This guy is, I'll tell you this, I'll give you the quick introduction. Greg Weldon is the guy other analysts follow when it comes to what's going on in the markets. He's got a depth to his research that saves an awful lot of time if you're an investor, because you know you're getting the real goods with him. Greg joins me on the line right now. Greg, I'm going to start with this. You were joining us. I can't remember if it was January, February, whatever. And man, I remember you telling us about gold, and you said, I think this is a place to be. You gave some examples, et cetera. Man, did that ever work out?
Yeah, Michael, it was actually early January, and we had started to turn bullish on the precious metals in November, late November, early December into January, and we wrote our gold and silver time to rise and shine was our Outlook 2016 research piece. And we basically said, look, I mean, this is a secular bull market. It had a 12-year bull run from 1999 into the highs around 2011. It had a very well-defined correction that was 4 years long, which, mathematically, it's a perfect 3-to-1 ratio. It was a 50% retracement of that bull move over that 12-year period. And interestingly enough, too, is when you dipped below the 50% retracement, you saw very aggressive accumulation of gold. You had many upside reversal days from just below that price level, which was below $1,100 an ounce. And we came to learn not too long after that in fact, the Chinese were aggressively accumulating gold at those levels. So for me, it was really kind of an easy call. And, we follow gold and we're known for our gold analysis, but we're not gold bugs. We're not always bullish on gold. We were on your show many times in 2012, 13, and even into early 2014, where we were, in fact, outright bearish. And we had, very blunt conversations about how you didn't want to own gold in those periods, where you were going to have a tremendous kind of almost generational type of buying opportunity, and that's how it unfolded. So to me, all humility aside, it was a pretty easy call, and it's played out pretty much exactly the way we thought it would. From here is where it gets really interesting, though, because maybe the market's a little bit overcooked in the very short term, and that's why we've produced another research piece here. What is the real value of gold in today's market? And just kind of looking at it from the perspective, at 1,300, is gold gotten expensive, or is gold still cheap? Is it value on a relative basis? And I can tell you, Michael, I'm as bullish on gold here as I was back in 2005 when I wrote my book, when gold was trading around $450 an ounce.
I also don't want to give people the impression that's all you do. I mean, you do excellent work on the stock markets, on exchange-traded funds, on currencies. There's a wide variety, and I'll get to some of that with you in a few moments. But I was talking with Michael Levy earlier in the show, and he was just sort of listing off. It seems like every week we've got another very big name in the investment business. This past week it was Bill Gross, again, talking up that you've got to have a portion of gold in your portfolio. Is that influential? Do you think once you start getting some big names sort of clicking into this, are they sharing their true thoughts? Are they, of course they've got so much money. I wouldn't, maybe putting $100 million in gold isn't a big deal. Who knows? But I'm interested to see all of these reports coming out over the last, say, 6 months. And, it seems that every week there's another big name.
Well, I think it actually very much reflects what's going on in the background and what the driving force is behind this move in gold. And that kind of plays into where we think it is now on a shorter term basis, where speculators have piled in. And you might need to purge positions a little bit here to clear the decks. But you're going to have that type of buying underneath this market. You're going to have buying from a commercial account. You're going to have buying on we need a percentage of our portfolio in gold. And there's actually, if you really want to slice it all down, there's one very simple reason. When you have $11 trillion in sovereign debt yielding negative yields, I mean, they talk about gold is kind of people that don't like to invest in gold will make the argument that it doesn't yield anything. Well, right now it yields a heck of a lot more at zero than $11 trillion worth of government debt out there. So I think from that perspective, it's glaring how you do have this kind of need for safety again that the Fed removed when they were expanding their balance sheet for a couple of years there when gold was coming off. You don't have that now, and people are kind of seeing what's going on and, you know, kind of thinking, hey, this is a little crazy. So they want to own gold. I think that's the right move, and I think that reflects, you know, kind of the overall macro backdrop that we're facing right now.
Well, I think what your point is such a good one is that, you know, my straightforward approach is money's got to go somewhere. Well, it used to be you know, gold was in competition with, say, a 5% T-bill or something like that, you know, the norm rate. Now we've gone to negative, as you say, on $11 trillion. Gold, there's no cost to holding gold any longer. There's no alternative in that sort of sphere that you go, that's yielding a lot better. I mean, look at the Canadian bond still hovering, 10-year government bond around 1%. You know, the U.S., whatever it is, it's under 1.5%. I mean, there's no competition anymore, or that big negative argument has now been removed.
Yeah, and what's happened, you know, it's basically it's two. We kind of have two themes around that. One, of course, is the hunt for yield. I mean, you have people with liabilities on a long-term basis that are running out of stuff they can buy, and you know, trying to meet those liabilities with some kind of return on capital here. You have to, and this is what the Fed wanted. This is what central banks wanted, was for investors to have to buy higher risking assets. In other words, to keep this whole thing reflated, they have forced people to, you know, pay up for assets at a low yield that, you know, you wouldn't have ever contemplated where junk bonds might be here or some of these things. And for sure, it has caused, you know, people to really step back and take a look. And you talk about Canada, Michael. I mean, this week's, and I don't need to get off track, but this week's macroeconomic data in Canada was glaring. You have a record trade deficit. You have the second lowest participation rate. Actually, it's the lowest participation rate ever, and the second largest monthly decline in full-time jobs since the crisis. You have a central bank that's already cut rates to 50 basis points. You don't have a heck of a lot of room there. And in fact, in a stealth way, and I'm not sure a lot of people even realize this, the Bank of Canada is expanding their balance sheet rather aggressively here. So they're kind of executing QE without really telling anyone they're executing QE. So this is a case in point to gold. If the U.S. is going to raise rates, what does that leave Canada with? So again, and when you look at gold in Canadian dollars is less than 100 Canadian dollars from its all-time high.
You know, it's such a great point. I was hoping we'd get to that, is that, again, gold measured in different currencies. I mean, obviously, we always quote it in U.S. dollars, but I'd said a while ago that I thought the low was in Canadian dollar terms, even though I wasn't sure if it was in U.S. dollar terms. And look at this. We got the Canadian dollar was down a cent on that trade data you just alluded to, when they showed the trade deficit. I mean, it's incredible. And here we go again with the Canadian dollar. But again, that's why I think gold will be seen as an alternative here, because I think it's also essentially a currency play. Someone stands back and go, where am I going to put my money? Because I sure don't want the euro. I don't want the yen. I don't want much else other than the U.S. dollar. And so this has a place in a portfolio.
Yeah, and I mean, the Canadian dollar is breaking down right here. You know, you had a nice rally from below 70 to around just over 80, and you're coming off, and you've taken out the kind of the support level around 76. The technicals have turned back to the negative side. So we're actually turning bearish right here again on the Canadian dollar. Again, I don't know that I would buy gold in Canadian dollars right here. I think you sell the Canadian dollar and wait to buy the gold on the next dip and kind of leg yourself into a position in gold in Canadian dollars. But you mentioned the currency. You know, our perspective on this, a lot of our work is currency related. We believe that, this is a massive currency war that's really been going on for a long time, but most specifically since the end of 2013. And when you look at the case of Japan, you have a currency that's breaking out. They don't want it to break out because it works against their goal of achieving reflation. I mean, this is part and parcel to why gold looks so exciting here, is because every central bank in the world outside of the U.S., and the U.S. will come back into play, mark my words, are trying to manipulate policy to keep their currencies from rising or to get them to actually move lower. And as you know, you can't have every currency moving lower unless something's going up against it. And in our view, it's quite clear that something is gold.
Just quickly on that, we got to take a break. But again, when you see these kind of currency wars and the devaluations that have gone on, is that contributing a ton to the volatility we see, or is it just a reflection of that volatility that's underlying that?
Yeah, I think it's kind of both. I mean, it is a reflection of the volatility, but I think more than that, it's a reflection of the level of desperation that you're starting to reach. And again, Japan is a perfect case in point. You know, Japan has been a forerunner in all of these types of policies that central banks have been pursuing. And we think when you have this discussion around perma bonds, you know, permanent bonds where they keep rolling over, potential for a big fiscal expansion beyond what they just announced, which really, you know, they tried to shock the market. I don't think they succeeded. And I think ultimately when you talk about things like helicopter money, it seems as out of the question to talk about that as it was in 2006 to talk about central banks monetizing government debt and expanding their balance sheet by trillions and trillions of newly printed dollars. That was considered monetary heresy back in 2006, just as much as thinking helicopter money can't happen. And guess what? That happened in 2006, as we know, 2007, 2008, 2009. And I think the setup here is very similar to get central banks to be forced to that precipice where they do whatever they have to continue to try and keep deflation from, you know, maintaining an upper grip here.
I'm talking to Greg Weldon. You can find him at www.weldononline.com, www.weldononline.com. Back with Greg. I'll get a quick overview on stocks and just his general view. I'll go back to the currencies for a second, go back to gold and silver, all of that coming your way. Stay with us on Money Talks. You're listening to Money Talks. Coming up, I got a shocking stat for you that's right down the line of what we're talking about. I got a good Goofy award. Victor Adair is chomping at the bit at the trading desk. And Ozzie Jurock, are we really seeing the signs of a significant slowdown in the real estate market, especially when you look into Vancouver? He started talking about that about 2 months ago. We've got more data for you. You should pay attention to it. Right now, Greg Weldon is with me. We're talking, we start off talking about gold, and we're going to come back to that in a second, but Greg does a heck of a lot of other things. Greg, can I just do a Barbara Walters on you and get some quick takes on things? Sure. And we'll start with, broad view of stocks.
Well, the broad view of stocks is you really need to narrow the focus to which country you're talking about because you have very divergent action in stock markets. Clearly, the U.S. at new highs. I think you have reached kind of a tipping point in global bonds here where you may see some flow out of bonds into stocks. In the U.S., you had a fairly strong employment report. I mean, you have people moving from not in the labor force into the labor force, finding jobs, second highest number of people that were not in the labor force that found jobs in the month of July in history in the U.S. That's a positive. But what you don't have is wage reflation. Headline numbers notwithstanding, the innards of the wage numbers were the same, sideways at best. And from that perspective, it kind of keeps the Fed on hold. There was no rush to price in Fed tightening off Friday's payroll number in the U.S. And as a result of that, you're kind of in a Goldilocks little spot for U.S. stocks. They break out. You get flow out of bonds. The problem, and I like Canada right here as well, but then you look at other places like Italy, Spain, even Japan. They look terrible. So you have major underperformers. You have some that will outperform. But the problem in the countries that are outperforming, like the U.S., is if you get bond yields to start to rise too much on this kind of flow and the thought process that, you know, maybe the Fed ultimately will be pulling the trigger, I think that stops rallies in stock markets dead in their tracks at some point. You don't have the growth dynamic in the economy necessary to really create another huge bull market for me in stocks. So it's a trade, not an investment, and you have to be very selective.
What market scares you the most right now? I mean, if we can just categorize, stocks, bonds, precious metals, or a particular area. Like, I'm worried about the banking system in Europe right now. I think that's a big black cloud overhanging every investment, because if it goes into trouble phase, you're going to see a lot of liquidation everywhere.
Well, what scares me is kind of all of the above, frankly, to some degree. But, yeah, Europe, you hit on it right on the nail, right on the head here. I mean, what is kind of not talked about, what seemingly has been swept under the rug and completely forgotten about as a major potential landmine out there, is sovereign debt. And when you look at Europe, pretty much every country, not every single EU 27 country this applies to, but the ones that are debt offenders continue to be debt offenders at the most egregious levels ever. Debt is growing there. We know in the U.S. you've gone from $9 trillion to $19+ trillion. Japan is at new highs. I mean, almost all of these countries see new highs in sovereign debt. Now, that's all well and good when you have bond markets that are under control. To me, the scariest kind of market would be the bond market, and that is where you kind of come back around, potentially bring the Fed back into play, get something dramatic out of the ECB or the Bank of Japan, and that brings us full circle all the way back to why ultimately on this next dip, should it take place, you want to be buying gold because central banks are on the verge of kind of losing control of bond markets, and it'll be very interesting to see how far they're willing to go and what they will actually do to try and rein them in down the road, and they're going to have to.
Hey, Greg doesn't know this, but I talked to his office earlier this week because, back in January we had his report on gold and silver, and of course it proved to be so profitable. It's the bottom line. This is a bottom line business, and so he's got a brand new report coming out that if you go to moneytalks.net, you can get it. It's regularly $249 US until Sunday night, midnight. You can get it for $99 US. I didn't say that earlier because I didn't want Greg to hang up on me, actually. But normally $249. You can get it till Sunday midnight at $99. It's the next report on what's coming, looking at that gold and looking at that silver market, which I appreciate, Greg. I'll say thank you now. As I say, I didn't want to say it earlier. You might not talk to me. But we really appreciate that. Also appreciate when you always take time with us here. Let me just finish going back because it's such a big issue for us in Canada, and obviously it relates to the U.S. dollar, but back to the Canadian dollar for a moment. You alluded to the fact that it had to hold 76 cents on the short term, and it didn't. We saw that breakdown, a good cent down actually on Friday before it was sort of dickering around. What are we looking at now, though? Do we start looking at the old lows or just another number?
No, I think you do because you're looking at a macro situation that is soured very quickly in Canada. You were talking earlier about Ozzie being on about the real estate market. You do see signs there, too. I would totally agree with that you've reached a peak and you are in the process of rolling over. And that's been one of the stronger areas in the Canadian economy. And it gets back, too, to the same thing. Again, I can't stress this enough. I mean, the Bank of Canada's balance sheets now, in terms of their assets, is above $100 billion in Canada. And that's a 65% increase from 2011. It's a record high. So from that perspective, when you tie all those things in together, Canadian dollar is very vulnerable here. So I could absolutely see it testing, if not ultimately longer term, breaking those lows below 70 cents.
Greg, it's one of the best things for me doing this show every week is getting to talk to analysts like Greg Weldon. Great stuff as always. I so much appreciate you taking the time with us, Greg.
It's my pleasure, Michael. You do a great job, and I'm always happy to participate and contribute.
A reminder, go to moneytalks.net. This is the offer for Greg's latest report. It's just out here. I'm not even sure if it's released, but it will be shortly. It's normally $249 until Sunday at midnight. You can get it for $99. I just think if you're interested in the gold and silver market, this is kind of the must thing you've got to do. I got to take a break. I'll come back. I got a shocking stat. Oh, dire straits and money for nothing. I don't think we can promise that, but we can promise to help you make some money here, maybe save some money in this environment. Interested to hear what Greg Weldon had to say about the world of gold, and I think you should take advantage of his offer. You just go to moneytalks.net. It's right in the front page there. You're talking about, what's the value of gold in today's market. It's an 80-page report, 30-minute video commentary. And, again, we have a special offer here, moneytalks.net, but you got to do it by Sunday midnight. It's $249 regularly. It's more than 50% off. It's $99. We always ask our guests to do that for a short period of time, at least for our listeners who are interested. So take advantage of that. I think you're going to find it very instructive. I mean, Greg's a terrific analyst, and you'll find it very instructive going forward. Hey, just another reminder, you can go. I want you to join me at Michael Campbell's Money Talks on Facebook. Just sign up. You're going to get a lot of information coming through you on that one, and Money Talks tweet. Time now for this week's shocking stat of the week. Now, I mentioned earlier the overused expression, the definition of insanity is to repeat the same actions and expect a different result. Well, man, we got more proof of that this week. This week, the Bank of England and the Australian Central Bank both lowered interest rates, which in turn what it does is pushes investors and pension funds into riskier assets they just can't afford. In a pension fund, for example, I don't know one that doesn't count at least at 6% annual return, usually more like 7 and 8% annual return. Well, they can't stick it in a government bond if you're getting 1% for 10 years. So they got to push it into something else. You know, I'll also, by the way, back to trying to get a different result from doing the same things, lowering interest rates doesn't have a positive effect in an deflationary environment. That's what we're in. It also hurts savers, hurts retirees. Why? It cuts back on their income coming in and in turn reduces consumption. But be that as it may. You want to know why the U.S. stock market's going up despite some economic and financial troubles? Well, we've been telling you this since March 2009. This is a reason to listen to Money Talks. Money Talks says that you got to put the money somewhere. You can't have a pension fund stick its, hundreds of billions of dollars under the mattress. No, and the first choice has consistently been U.S. Treasuries and stocks. Now, I think that Treasury game may be coming to an end, and stocks going to be the number one beneficiary stepping up. I've been consistently saying I'm a long-term bull on stocks. Even when we get some of those really sharp, uncomfortable corrections, if you're in quality, dividend-paying stocks, I think there's much more to come on the upside. And I got a stat that this week that absolutely verifies this approach. The Swiss National Bank increased its U.S. equity holdings, are you ready, by 50% in the first half of 2016. So they get the currency exposure and, as I say, you're in a bullish move overall long-term in the stock market. Which brings me to my shocking stat of the week, though. It's a very simple one, straightforward. Since the subprime mortgage crisis in 2008, guess how many times central banks around the world have reduced interest rates? The number? 666 times since the subprime crisis hit. Reduced interest rates 666 times. Has it worked if you're looking for actually expediting or enhancing economic growth? I think the answer is no. What it's done is it's goosed the value of some assets, as stocks being a very obvious beneficiary. Weldon says gold's going to be up next. Well, we'll take a look at that as we go through, but 666 times. I'm going to take a break. We're going to talk about one of the asset classes in certain areas that's certainly been goosed, and that's real estate. But are we in a sea change there, especially when you're talking about the Canadian real estate market led by Vancouver? Ozzie Jurock's up next. We'll ask him the question. Coming up, Victor Dare live from the trading desk. Right now, though, I'm joined by Ozzie Jurock. You can find him at www.jurock.com. Ozzie, quick question. When we're looking at the health of a market, because I want to talk to you about whether we're seeing a significant slowdown or not, do I look at the price as it's being maintained, or do I look at sales volume? Which one would you say gives you a better indication of the overall health of a particular market?
Well, certainly the sales are very important. So when sales fall, and then the active listings at the same time were to rise, then you clearly know that the top is in place and sales prices are going to come down. And the opposite is also the case. If sales would go up dramatically and listings rise, then we know we're going to go higher. Well, today we have sort of a unique thing in the middle. We have detached sales in Vancouver down a whopping 30%. So last year we sold about 1,600 in July, and this year we sold about 1,100. At the same time, we're still down in listings by 28%. And I think it's like a tide washing against the beach. The owners right now, half the owners believe that maybe I should come to the market now, and the other half says, no, maybe I'm going to wait. I think that the tide is going to swing towards many more listings that are coming on the market this month and next month will tell the story.
So we've had 4 months of sort of slowing market in Vancouver, for example, and I only use Vancouver because obviously it's got the headlines across the country along with Toronto, but we've had 4 months, and we've talked about this before. You were very early in this, but, I'm always wondering, it's the summer doldrums, no one's going to sell anything in the first week of July, the first week of August, first week of September. Do we have to see through into the fall before you would sort of say definitively it looks like we've got a big change in the market?
I would say normally yes, but look, we're measuring ourselves against last year's summer doldrums. And Richmond detached sales, for instance, are down 42% over last July, which was also the summer doldrums.
Yeah, great point.
West Side is down 29% in volume, but on the detached side. Condos overall are also down about, between 7 and 15%, depending on the market. So we're seeing a general decline in sales, and I think it's going to accelerate. Look, Michael, 15,000 transactions made to the land registry office trying to beat the negative tax. And so there was a lot of sales came through. That will also skew the markets a little bit when we get them at the end of August. But I see for my realtors that we have around that everybody is telling me that anecdotally things are slowing down. Victoria may still be very hot. Rick Hogan-Dawn tells me is super realtor out there. But he says there are no more $100,000 over asking price. And so we are having, generally speaking, a shift in the feeling of the market.
Let me get to Alberta here. Let's talk about Calgary. Let's talk about Edmonton.
Yeah, the interesting thing, of course, is that in Calgary, we expected it to be down. We expected it to be lower. The president said the number of unemployed workers keep rising, and when you combine job losses with declining net migration, the result is going to be weaker housing demand. So they're down about 13% this year over last year, and it's a 20th month of declines in a row. But actually, Michael, 4.5% down in price in detached and about 7% lower in condos is really not as bad as some people predicted.
Certainly not like the decline in oil prices, as an example. What about Edmonton, though?
Edmonton, even Steven, sales are down 15%, but the prices for detached homes are actually up a tad, and condo prices are down a tad, about 3%. The big mover and shaker is still Toronto, 10,000 sales, best July ever. Michael, if you take Vancouver, the Fraser Valley, Calgary, Edmonton, Saskatoon, Kelowna, and Victoria together, we don't have 10,000 sales, or just barely. So it's still a whopping big market, and it's up 21% in prices for homes, and condos are up 9%, and the listings are down. So that market is going to continue into the fall with some momentum.
Yeah, really, when you get those listings down to that degree, it's pretty easy for prices to be maintained and go up, as you just described there. I'm looking when I see, though, like for Calgary, for example, and you don't, it is the 20th consecutive month of year-over-year sales decline, but the prices have sort of held pretty well in that under that onslaught. I just wonder if that represents, like I always say, we talk a lot about pricing, a lot about the market. The number I would like to know is how much mortgage debt is on individual houses. Like they talk about a bubble in the upper end in Vancouver, I say, tell me how much has been paid in cash, how much is mortgage. Because if it's not, if it's predominantly cash, you're not going to see a big correction. Bubbles burst only because of credit problems. And I'm just wondering if that shows an underlying strength, at least, of who's owning the homes.
I would say it does, because certainly as Canadian homeowners in general, we are the most, and I think the largest homeowner country in the world that has its mortgage paid off, clear title homes. So the number is somewhere around 40%, but it's that kind of strength which, when CMHC makes a discussion, it doesn't have them worried because the foreclosure rate is still low. But that's going to change. What is astounding to me is that the West Side average detached home price went to $4,270,900. I mean, that's up from $3,400,000 a year ago. That's up 25%. I mean, yes, sales are down, but that price is outlandish.
Yeah, no, I could have used that as my shocking stat. You should have told me in advance. Ozzie, give me a hot property.
Yeah, we got one in Victoria for you. Victoria is a 2-bedroom, 2-bathroom condo built in 2006, and it's listed for $235,000. It's the cheapest in the Greater Victoria area, so that's our hot property for the week.
Great stuff as always, Ozzie. I mean, it is a fascinating market right now. We've got to keep our finger on the pulse. That's why we're so pleased to have you here with us every week, and you can find more with Ozzie at JUROCK, www.jurock.com. For hot properties, you can click on that button. Ozzie, go out and have a terrific weekend.
I will, thank you. And I've discovered fishing in Secret Cove here now, and I learned that if you give a man a fish, he'll eat for a day, but teach him how to fish, and he'll sit on a boat and drink beer all day. I mean, this is wonderful.
Hey, that's a German expression. Okay. Thanks, Ozzie.
Okay, thanks. Bye.
Take a break, come back. I got Victor Adair. You know what Ozzie's going to be doing for the rest of the weekend, but I got Victor Adair. He's live at the trading desk. This guy never stops working, never stops looking at the global markets. We'll share that with you. Plus, I've got a Goofy award for you. You know what? The politically correct police are out again. The Hurt Feelings Brigade. My question is, when do we say enough is enough? We'll do that in the Goofy coming up across the Money Talks Network. Coming up, I got a Goofy award for you. I'm looking forward to this one. Did you hear what Clint Eastwood had to say this week? Well, I'll share that. It's the intro to my Goofy. But right now, I'm going live to the trading desk. I got Victor Adair on the line with me. Victor, I got to go from last weekend. You said, you know what? And I think it's great advice. When you get unsure, move to the sidelines. When it looks a little puzzling, well, that's what you told us you had done. You'd had a good trading month at that point, so why blow it in some uncertainty? Did that change during the week? Did things clear up, or you're still on the sidelines?
No, Mike, actually this past week was a great example that trading is not a game of perfect. You never bat 1,000 on the trading side. And for instance, I started the week with a long position in the U.S. dollar index, but the euro currency continued to rise early in the week, despite the fact that the whole European banking sector, like the share prices of the European banks, is just getting hammered. And I thought, I just can't make any sense of this, and I'm losing money on the trade, so I had to get out of it. And then at the end of the week, of course, the U.S. dollar is up huge on the employment data. Same thing with the Canadian dollar. I'm short the Canada. Canada refuses to go down. So I think, well, okay, I have something wrong here. I don't understand. I got out of that, and then Canada takes a big dump on Friday. So it's like, oh, boy, I'm glad there were small positions, but you certainly don't put the puck in the net every week.
Yeah. Let me just quickly say or ask you, we had the rate cut out of Great Britain, the rate cut out of Australia. It's just more of the same, not just in their methods, but it's also, the influence on the market. Obviously the British pound's going to take a beating after that. Yeah,
and the pound was down on that. The central banks, continue. It's a central bank market you're trading out there, and, ignore it at your peril. If I could segue there, but here's the thing. There is a massive short position in the British pound. And I'm wondering, and this is not a trade recommendation, I'm just wondering if maybe Europeans who are afraid of what's going on in Europe, and they're looking at how expensive it is to put your money in Switzerland, the foreign exchange rate there, how much it is maybe less expensive to go to U.S. dollars, if maybe some Europeans are going to think, hey, maybe I could just buy British pounds now that they're outside the euro. It's pretty close to home. The British pound has been hammered for about 20% or so here in the last month or so. Maybe it's a bargain. I'm just wondering. That's the sort of thing as a trader that you do. You see a market that's with this huge short position. You think, okay, the news is out. Maybe there's a natural buyer. That's an idea anyway.
Especially when there's a big position that's playing it to go down. My bet is if you get that sort of even interim bottom, man, the slingshot move up might be significant in a few days. As people cover their shorts, they've made a lot of money, and they say, hey, I'm going to lock in my profit at this point. So that's a very interesting market to watch. Hey, Vic, before I let you go, I got to ask you a couple more things. Let me just go very quickly. The market's making a bet on the presidential election. Who's going to win?
Hillary.
According to the markets.
Yeah,
Sorry,
according to the market, Hillary's it's a lock. By the way, thank you very much for having my old buddy Greg on, and I very much agree with him that, very short term here, the gold market looks like it could have a setback, and I also very much agree with him that the Canadian dollar looks at risk of falling a lot more.
Very quickly, what about oil? That's the one we haven't talked about. It's actually going according to plan here. We were very clear on Money Talks. You were very clear saying, at that $51 mark, the party's over and we're heading back down. You got any numbers for us right now? Do you think it's going down further? And then do you have sort of I know the market will tell you, but still a broad target?
I had covered my short positions in oil the week before, and it fell more early this week, and I thought, I'm out too early. But then we're up about 5% from I think we had 4-month lows midweek. I think there's some potential for oil prices to climb a little bit here, but it's still, my hero here is Joseph Schachter. It is a supply-demand story. There's a hell of a lot of oil out there, and the demand's just not there. So I think there's a risk on that basis of oil prices going lower, certainly below $40 again.
We'll keep an eye on it. Victor, thanks very much for finding time for us. Good stuff.
Good to talk to you, Mike.
My thanks to all my guests here today. A reminder that Money Talks is brought to you by Solera Club. Solera Club is a royalty-based investment. And just a phrase you should know, that means you get paid first in this case. Also, there's no fees. It's in the tech sector. For more information, go to soleraclub.com. Time now for this week's Goofy Award. Earlier this week, I thought this in true Dirty Harry fashion, Clint Eastwood called the current crop of 20-year-olds, 20-somethings, the pussy generation. Well, it's interesting. I'm not sure what happened to Rohina Sethi this week. She's the elected student body vice president at the University of Houston. I don't think this is going to change his mind on that one. This came in the aftermath of the killing of 5 Dallas police officers. Well, Ms. Rohini posted on Facebook, in quotes, hashtag forget Black Lives Matter, more like all lives matter. Well, she subsequently deleted the quote after some pressure, but it was too late. She was suspended from all student body activities, student government activities for 50 days. And this is the interesting part, because as a student, or the president of this, the student body president, President Shane Smith, told the Washington Post, many in the student body felt she didn't respect the struggles in their lives. Now, he didn't elaborate on the specific struggles faced by students at the University of University of Houston, so I don't know. But I'll finish with a quote from increasingly popular YouTuber Blair White. She says, oppression is not hearing a word that offends you. Oppression is being told you can't say certain words because you might offend someone else. I thought it was a very interesting insight. But again, at some point we've got to say, when's enough of this? I mean, it's unbelievable, because I'll tell you, if you don't get this in check, well, you're seeing what it happens. It's actually a fascist attitude of you can't say this, you can't say this, that. It's incredible what it does, and it's cost a lot of people's jobs for the most innocuous things, and the latest victim I just alluded to. That's all the time we have for Money Talks. But in a reminder, I just want to say, go to moneytalks.net. There's 5 really fantastic articles on that. But you can also sign up for the Greg Weldon offer. Also, join us on Facebook, please. Money Talks, or Michael Campbell's Money Talks and Money Talks tweet. The thing I'm really dying for is to get your kids involved, listen to us. I think it's important for their financial survival. Thanks for listening.